Hello, my awesome accounting students. Welcome back for chapter 21.
For today. By the way, as you know, everything that we're looking at is in the modules link. So today we're talking about decentralization. So if you look at that word, DE is the prefix that means not. So literally that means not centralized. And so this chapter is about taking the power away from the top levels of management and distributing it to mid-level or lower level management. And what this chapter is about is how do we custom tailor reports for these various levels of managers. We want the reports to be meaningful, especially in terms of performance evaluation. If a manager is responsible for a certain type of budget, we want to make sure that he is being evaluated on those items that he can control. So decentralization is the process of taking power away from the top and creating accounting reports that will accurately reflect, or I should say not reflect, but meet the needs of whatever that manager needs, or possibly whatever his or her boss above them needs to help them evaluate performance. There are advantages and disadvantages of decentralizing, and there is another handout for you that's specifies those. So this is in the modules link. So I think this is true of, I think some of the disadvantages that they list are true of almost all businesses. But let's go ahead and read through this because this is an important part of the chapter. So the advantages of decentralizing is that lower level managers have the ability to react more quickly, right? If I go to the local McDonald's here and I have a problem with my food item, I don't want to talk to the CEO of McDonald's because he can't fix my problem right then and there. It would take me weeks, maybe months, if ever, to get through to that person. But the manager on site here in Huntington Beach might be able to fix my problem right away. So that's one advantage of decentralizing. We just mentioned they are closer to the customer, and so they can usually be a lot more responsive. The operation, McDonald's is a premium example of how the operation can provide a better training ground for managers. If you want to own a McDonald's franchise, which is very difficult to do, they are highly competitive in what they're looking for. And one of the things that will bump you very high on that list is if you've gone through, and I'm not kidding about this, Hamburger University. Right? It is a real life training ground. I've read many training books on it. It's amazing what they're able to do. And so their goal within McDonald's or other companies is to train their potential higher level managers from within. Another advantage is when you do delegate responsibilities, it tends to improve the employee morale. In other words, if I have a stake in what is being discussed, if I have input into the budget, if I understand that we're in this together as a team and we need to meet these goals, and if I feel empowered to do that, then my morale is going to improve rather than just someone like, I don't care what you do, you just need to meet the goal, that type of a thing. And another really important thing, I think, is that we free up our top level management to be the vision makers, to be the ones that look into the future 5 to 10 years. We don't want Bill Gates, for example, worried about signing accounts payable invoices or what type of piece of equipment this entity is going to purchase. We want to let the visionaries do their creative thinking and work on this strategic planning into the future. When we decentralize and we take that power away from the top, it frees them up to do other things. The disadvantage, this is definitely one, when you decentralize, you have mid-level offices usually, and so that usually takes another set of assets, and sometimes staffing might be duplicated. So that's always that cost benefit. You got to weigh whether the advantage of decentralizing and maybe making, for example, geographical territories for your company, whether that outweighs the extra cost of having an extra office and support staff to run the offices. And then this last disadvantage, I think we always have to worry, always in a capitalistic society, about managers pursuing their own goals. I think that's always an issue, right? So we can train someone to be the best uniform maker, for example, in the business, and how to create these really cool looking uniforms, custom uniforms. I think all companies worry about, okay, after I've invested so much time and effort into creating these really cool uniforms, is this person going to go off and start their own company and leave me high and dry type of thing? So I think we always have to be concerned about that happening. So back to the agenda, I wanted to just get those decentralization slides in there so you know that they're there. And I do clearly remember there being a couple questions, multiple choice questions on advantages and disadvantages. Whoops. Let me go back to the agenda. I hope I haven't lost it. There it is. We're going to talk about 3 types of responsibility centers today. So again, read the chapter. Hopefully you've watched the video. I saw that most people did. And you'll learn about 3 different types of responsibility centers. Today, we're going to tackle cost centers and profit centers. And then when you come back next time, we'll talk and tackle investment centers. And we'll define each one of those as the lecture goes along. And then as we take a look at these different responsibility centers, we will talk about the reporting for each. One of the major challenges today that we're going to work on is allocating out indirect costs. When you have direct costs, those are easy. They are tracked in the accounting system as being for the benefit of a specific department. But when you have indirect costs or shared costs, those can get a little bit trickier. So for example, if we have 4 or 5 departments in Nordstrom's, right, they may share the rent. What's a fair way to distribute the rent? Maybe square footage. They're going to share a big electrical bill. What's the best way to allocate out the electrical bill? If this sounds like deja vu, you'll notice that many of the indirect costs go back to the concepts we learned in activity-based costing. If you can figure out what causes the cost to happen, then that makes for a fairer allocation. So we're going to work on that today. And this is a word that I want written down in your notebooks. The departmental contribution to overhead is one of the main concepts that we want to learn about today. It is a specific line item in an income statement that we will be looking at today. And I remember it also being focused on the exam as to what that means and what we can compute and do about situations where a company may not look like they're profitable based on a GAAP income statement. But anytime we're thinking about eliminating a part of our business, we definitely want to look at a whole lot more information than just what GAAP requires us to disclose. Remember, the course is called Managerial Accounting. We're more interested in the accounting for internal use than we are about the accounting for external use. That's where we're headed. I would use that again as a checkoff sheet for your exam. Do you know what decentralization is? Could you list a couple advantages and disadvantages by the time we're done? Can you define what these 3 centers are responsible for? And do you know what the reporting looks like? That's why I put these agendas in here. Questions so far? Okay, then the handout here. I think this is, I always battle with myself on whether I should go through the handouts or go through PowerPoints. Sometimes I do one or the other. I'm never quite sure what's more meaningful to the students, I'll say.
I tend to like PowerPoints, just my 2 cents.
Visual, okay.
Well, they have pictures and diagrams and stuff, so that helps.
Okay, perfect. I do appreciate the feedback. In fact, you just changed my mind on that today, and that's a good thing. So
but that's just me, so.
I totally understand enough, but you have some wise insight, and I value that. Okay, so one of the reasons why you might decentralize is because large companies are easier to manage if you divide them into smaller units. Sometimes we call them divisions, sometimes we call them segments, sometimes we call them departments. They could be organized around a whole different host of ways. Geographical is very common. Companies in the United States tend to decentralize by having geographical locations. For example, West Coast, Middle America, East Coast, for example. Others tend to decentralize based around certain products, right? Like Boeing had space shuttle systems was one of their areas. So no matter how you do it, decentralization and the techniques we're talking about would work. So what this book focuses on are the three major types of centers that can be used when a company decides to decentralize. The cost center is very simple. It's going to be the easiest one we talk about because a cost center is solely responsible for the costs incurred. So using Boeing as an example, my neighbor 2 doors down used to work on the space shuttle, and his specific division was 100% focused on, I laugh because they call it life support systems on the shuttle. And when I was sitting down one day and saying, what exactly does life support systems do? He was responsible for maintaining the toilets, for lack of a better word, on the space shuttle. That's all his area was responsible for. So he didn't have any revenue coming in. He was simply in charge of making sure that this specific cost center for the space shuttle met the financial goals that they had established. And of course, on a bigger scale, that the astronauts could safely live while they were in space. So for responsibility accounting and developing a report for a cost center, it's going to be, and we're going to practice this shortly, it's basically going to be, here's your budgeted costs, here's your actual costs, and here's whether you were above or below. We use that in performance evaluations. If you're below your budget, that's usually a good thing. And if you're above your budget, as far as expenses go, then we probably need to dive deeper in and find out why. And you'll see the level of detail on the reports gets more extreme the lower we get in the management spectrum here. So that's a cost center. Most decentralized segments that I see are profit centers. That means that they're responsible. If you think about what profit is the difference between revenues and expenses. So a profit center manager is responsible for bringing in, or not just controlling the costs like over here, but also responsible for bringing in the revenues and cost control. So what we're going to do for a profit center is a modified income statement. When we get to the investment center next time, I'll tell you what it is today, but we're going to focus on it next time. An investment center is like its own independent company almost. It is responsible for the revenues generated, definitely for the costs incurred, but in addition to that, they're also responsible for securing the assets and utilizing them wisely to generate the income. So an investment center is almost like a company all by itself. And the example that I'll use is, for example, Taco Bell, right? Most people go by and they see Taco Bells everywhere. I just think in the 5 miles around me, I know there's quite a few of them. Taco Bell, you would think there's so many of them that they are their own company, that they have their own set of books. But Taco Bell is a subsidiary or a small part of a larger corporation. But the reports for them, because they operate so independently on their own, is going to look like those of an investment center manager. So we'll be learning additional measures. We're still going to be using profit center income statements. But because this manager is also responsible for utilizing assets, we'll come across some other measures in addition to that income statement that will help us evaluate whether that division or segment has done a good job. We'll be using return on investment, which is a ratio that I know you guys have heard of, and we're going to split it down into 2 components known as the DuPont formula, and we'll focus more on that next time. Okay, so I'm not looking at all of these slides, just a couple of them. Uncontrollable versus controllable costs. There are different schools of thoughts on whether uncontrollable costs should go on a manager's performance report. And the usual school of thought is if a manager can't control them, why would you put it on their so-called scorecard, on their evaluation report, if the cost is out of their control? So most of what we're learning in this chapter is going to focus on the controllable costs. And what that means is if the manager has power to determine or significantly affect the amount incurred, then it should be on some type of a performance evaluation report. And oftentimes I've noted is as various levels of management that if I know that I'm going to be charged for something, then I use the resource much more wisely than if somebody took it off of my schedule or off my report. So I think that's the other school of thought on whether you should include them or not. So responsibility accounting is the term that this chapter uses. It's a specific accounting system that is tailored to the need of whatever the management wants. And it's tailored for both the individual manager and possibly on the person above him or her, the one that's going to be evaluating that person. So we're going to see examples of that. Any questions so far? This is really hard to see in your book. It's Exhibit 22-1. It just shows kind of a chart of organization here, an organizational chart. We have the board of directors at the top, and down at the very bottom, you have the day-to-day managers that are working to control the employees below them. And I don't like the word control, who are looking to manage the employees below them. For each level that you see in this flow chart, there's a different type of report. The lower level managers down here are going to want individualized data for every line item that is on their budget. The upper levels, the president and so forth, he or she is going to want more summarized information, knowing that they can drill down to the detail if they need it. Our reports need to reflect whatever the management needs for us to do. I'm going to show you an example of one in a moment here. Yeah, here's the one I wanted to show you. And I know this is so hard to see. Get a little bit bigger here. So this is an example of a report that the vice president, somebody higher up in the chain of command, might receive. You'll notice that it's usually regional line items here, specific large items like the salaries that the VPs make. And you'll notice that here it's budgeted versus actual. And so if you pick a line item within here, in this case, they chose the West region, I think because it was the most over budget in this example. So look at that red line item. That manager might say, you know what, our West region was the most over budget. Let me see a detailed report just for that West region. So it's a drop down effect. So here's what a report might look like for the person that runs that region. It's going to have all the different line items and so forth. This puzzles me to this day. On this next level of report, they chose arbitrarily to me the $300 line item to look more closely at. So if I would have looked at the 2,700, they're more over budget. But for some reason, your author said, okay, I'm a little bit concerned about the beverage department. That was $300 over budget. Let me see a more specific report for that. So here we have a level of detail just for that one minute specific line item for the beverage department. I want you to see how the detail kind of flows up. In other words, this goes to this, and this goes to this, and you could go on forever on the level of details on these reports. So in this section of the book, we want to be able to answer questions and provide reports for any level of management that requests it, knowing that sometimes the information is needed to make an internal decision. You're going to see in our book today, in our class today, that we'll be talking about, should we possibly think about getting rid of this specific division? And other reports that we may need are just for a performance evaluation on a manager. So we want to be able to meet whatever type of need management's going to throw at us. And I think the last couple slides deal with, let me go out here, the category of expenses. We already know this from a previous chapter. Direct expenses are the ones that we could actually watch. It's for the sole benefit of a specific department. Those are easy to track. We can set up our general ledger system to track those for us. It's the indirect ones, the ones that we know are there. For example, the electricity. We know the electricity is there. We know that it's benefiting all the different divisions that might be under the Nordstrom's or the Macy's store, but we have to find a fair way to allocate out the expense. And again, as I read the chapter and as I was prepping this morning, I'm like, this is just activity-based costing. So the indirect expenses, we have to find a fair way to push them down to the manager level. And it changes, right? I might use kilowatt hours if I have machines that have the tracking of the hours on it to allocate out electricity expense. Somebody else might use the number of products, because if they're making more products, they're probably using more electricity. So there's not one right answer on how these things are allocated out. We're looking for a fair or a best way of taking these indirect costs and charging them out to the various departments that benefit from us. I think that's probably a good starting point to the lecture today. I'm always one that dives in and we work out problems, and I think we can kind of lecture as we work them out. So let me stop for a second, see if you guys have any questions. And
in this example, we're going to take a look at a cost center. It says Arctica manufactures snowmobiles and ATVs. These products are made in different departments, and each department has its own manager. Each responsibility performance report includes only those costs that the manager can control, and then they list them for you. Direct materials, direct labor, supplies used, and utilities. Let me use the draw feature of Excel and see if I can notate those. So direct materials, direct labor, supplies used, and utilities. And I want to take a look at that for the snowmobile. We're going to be looking at the budgeted costs as well as the actual costs, and then we'll calculate a difference. So on a cost center, remember, we're only concerned about costs that that particular manager is responsible for. Sometimes I have to click on because my cursor gets stuck. And it's usually after I'm done drawing. So let's try this again. So I'm going to list the cost items, which would be direct materials, direct labor, supplies used, and utilities. For those 4 line item expenditures that the author told us were controllable costs, we've inserted the budgeted amounts and the actual amounts, and for each one we'll want to calculate the variance. I prefer, as we discussed in a previous chapter, that you use F's for favorables and U's for unfavorables. In Excel, an easy way to do that is using the ABS or absolute formula and just take the difference between the two columns. That will show the variance as an absolute number. That means with no pluses and no minuses. Let me recalculate the difference here. And that means that we can go in and show them as either favorable or unfavorable. I should probably use that same ABS feature that I just described to you on the total. That will force us to think about what's going on with each one of these individual variances. So on the first one, we spent less than we were actually allowed to spend. That's favorable. On the second one, we spent more. That would be unfavorable. On the next one, we spent less. That would be favorable. And on that last one, we spent less. That would be favorable. And when we net the favorable of 260, the unfavorable of 260, With the rest of these, which are favorable, the net is $20, and you would take the sign of the higher amount. In this case, the 260 would be higher than the sum of the F's. That's an example of a cost center report. Easy, straightforward, and I think that cost center reports will provide no significant challenges for us. Let's get a little refresher on expense allocation. This will be needed when we do departmental income statements. This problem says Lucia Company has 2 service departments. That means those service departments service the other parts of the entity. So the 2 service departments are office and purchasing. Total expenses for the office are $24,000. So we'll have to find a way to allocate out the $24,000 in office expenses. And the purchasing department spent $34,000. Expenses for the office are allocated to operating departments based on sales. Okay, so there's the driver for the office expenses. And expenses for purchasing are based on purchase order. This is a little bucks over basis calculation where you're figuring out how much each one costs. Another way to allocate it out that your author uses is by percentage. So the office expenditures total $24,000, and the basis for that was sales, shown here in the K column. So based on the data given to us by the author, we calculated what percentage of sales each piece was. In other words, for books, we took the part of the pie or piece of the pie of $495,000 over the whole pie, which was $900,000. And we did that with each one of these pieces, and we came up with the percentages shown. Then we took that $24,000 that the author told us was expenses were incurred by the office allocation. We took $24,000 and multiplied it by the 3 percentages here shown. One way to double check your work is make sure when you add up the allocations that they balance back to the expense the author gave you. So there's requirement A. The purchasing costs were based on the purchase orders used. So here they gave us the number of purchase orders that each division used. Once again, we calculated what percentage of the whole pie that amount was. That 43% was derived by taking 516 POs that the books division used out of the whole thing, out of 1,200 POs, and we got 43%. And we took the $34,000 of costs incurred and multiplied it by the percentages that we just computed. Once again, another way to check your work is by comparing that $34,000 that the author gave us down to the amount allocated out. They should match. Let's go take a look at how this type of information would be used later on today in an income statement. Here's some more practice just to make sure that you know how to do departmental expense allocations. This company has 4 departments: materials, personnel, manufacturing, and packaging. And they give you the data or the drivers needed for those 4 different departments. So this is data that they've collected. They have the number of employees that each department has. They have the square footage that each department has. And they have the asset values that each department have. And they tell you that there are some shared or indirect expenses for 3 different line items: supervision, utilities, and insurance. And they gave you the basis on how to allocate each one of those $3 value line items. Pause the video and see if you can allocate out the $82,500 of supervision based on the number of employees, the $50,000 of utilities expense based on the square footage, and the $22,500 based on asset values. Pause the video, give it a shot, and we'll come back and compare answers. Let's see how you did. Did you properly allocate out the supervision based on the number of employees that each department had? Check out the answer and see if you got it correct. Then, were you able to base the amount of utilities on the square footage that each department incurred? Check it out, see how you did. And finally, were you able to push out the insurance of $22,500 based on the percentage of asset values? Take a look at the answer. And of course, if you have any questions, make sure you get those questions answered. Next, we'll see how these fit into an income statement. Next, we're going to take a look at what a performance report might look like for a profit center. A profit center is responsible for bringing in both revenues and expenses. In this exercise, we're going to take a look at a line item that's called Departmental Contribution to Overhead. And it is sometimes useful for isolating those costs which the manager has no control over and excluding them in the calculation of whether that division was profitable. In this case, the exercise says, below are departmental income statements for a guitar manufacturer. The company classifies advertising, rent, and utilities as indirect expenses. I think we'll go use the draw feature and just put marks on advertising, rent, and utilities. So real quick, let me get the draw feature. Advertising, rent, and utilities are considered indirect costs. That means that they are not directly traced to the two divisions of this company. If you look at this GAAP income statement, you'll notice after I get out of this draw feature here, that when I scroll down, if we scroll down and we see a version of the GAAP income statement, you'll notice that one of the departments, the electrical department, currently has a net loss. When that happens, oftentimes the question comes up, should we eliminate or get rid of this specific division? Well, rather than making a decision based on a GAAP bottom line number, oftentimes we will compute something called the departmental contribution to overhead to see if the department is even covering its own expenses. The departmental contribution to overhead is the gross profit of a company less the direct costs. And as we just mentioned, 3 of these costs, advertising, rent, and utilities, were considered indirect. So we're going to do a different version of this performance report, specifically focusing on the departmental contribution to overhead. So as always, as we do with all other statements, we'll get our sales number in there. We'll take out the cost of goods sold. That will give us the gross profit. And then from the gross profit, now we will classify the expenses as both direct and indirect. In this case, since they are considering the elimination of one of the segments or departments, we're going to focus on the direct expenses to see if that electric department of this guitar company is even covering their own expenses. So the direct expenses would be those line items that we did not check off in red. That would be for the depreciation, for the equipment, that would be for the salaries, for the supplies used. Excel is giving me a time today. Let's scroll down, and that would be all of the direct expenses. So we'll call this line item total direct expenses. And then the difference between the gross profit and these total direct expenses would be called the departmental contribution to overhead. Okay, now they asked us to do departmental income statements for both. So let's drop these numbers in. And here's the finished statements with the numbers dropped in. The division in question was the electric company, and you can see that they did have a positive or fairly significant departmental contribution to overhead. In fact, they are more than just covering their costs. What that means is it's possible that the indirect expenses, which typically are allocations of overhead, might have caused the net income to be zero. So if a company was deciding whether to eliminate the electric company, one might take a look at a performance report which focused more on the departmental contribution to overhead. And if that were the case, the company may decide that this department should not be eliminated because it is contributing $14,550 that helps toward offsetting other indirect expenses. The author did not ask you to complete the income statement. If I were doing this as a test question, I would have finished the income statement just to show you that the last line item does indeed total up to a negative 200. But once again, since the author asked you to focus on this important line item called departmental contribution to overhead, you can stop the homework problem right there and let me black out the rest of it. That's what the solution would look like. Let's work one more time on another departmental income statement that focuses on the departmental contribution to overhead. This says Sadar Company is a store with two operating departments, guitar and piano. They gave us sales, they gave us cost of goods sold, and they specifically gave us the direct expenses, which means those can directly be traced to the guitar department and the piano department. They also gave us two indirect expenses. Those are important to include in the overall reporting, but sometimes are excluded if a department is considering some segment elimination, as we just saw in the previous exercise. In this case, advertising is to be allocated out based on the percentage of total sales, and rent should be allocated out based on square footage. They give you the data you need in the box below. So this is a combination of expense allocation, as we did in the first part of today's exercises, and a departmental income statement, which we looked at in the last part of today's exercises. So if we scroll down, they want you to, number one, allocate the advertising and rent to the two operating departments, and then prepare departmental income statements. Pause the video, do the expense allocation first as directed, and then let's prepare departmental income statements to see what type of profitability both departments have. Pause the video and we'll come back and look over the answer. the first requirement asks us to allocate out advertising based on total sales. So we took the sales from the income statement, figured out what portion of the pie each one made up, and then multiplied it by the $15,000 of advertising expense that they asked us to allocate out. For rent expense, they told us to use square footage. So we took a look at the square footage for each of the departments. Following the same logic, we found out what percentage of square footage each one took, and then took those percentages and multiplied by the rent expense of $3,200. Those expense allocations were used in the income statement above. Requirement 2 asks you to prepare the departmental income statements. Let me scroll up and show you that solution. Here we go. Here's the departmental income statements for guitar and piano. They gave us the sales, the cost of goods sold, and the direct expenses. We see that one of them has a negative departmental contribution to overhead, and although the problem did not request that you make a solution, in the case where it was asked of you whether the guitar department should be eliminated, since they aren't even covering their own direct costs, that would be one good reason to take a look at possibly eliminating the department if they couldn't increase their sales or likewise could not decrease their direct expenses. This problem was focused on the full income statement, so let me scroll down. Here are the indirect expenses that we allocated based on the notes below. And we found that a GAAP income statement would show the first department, the guitar department, with a fairly substantial net loss. And once again, although the question didn't ask you to make a decision based on whether they should be eliminated, that negative departmental contribution to overhead does not look good for the guitar department. We'll come back and wrap up the chapter on day 2, where we focus on investment centers, which means that the departments operate almost as independent companies, meaning not only are they responsible for bringing in the revenues and expenses like the profit centers were responsible for, but in addition to that, they're responsible for the acquisition and utilization of assets, which means this income statement is not going to be an adequate measure because, as we know, there are no assets on income statements. It's solely revenues and expenses. So we'll have to bring some other performance measures in the mix, and we'll focus on that in day 2. Let me know if you have any questions. Professor Johnson, signing out.